Leaders drive values, values drive behaviors, behaviors drive culture, and culture drives performance.
Hey, welcome back, investors. Today, I have the pleasure of interviewing David Kotter, who is the co-founder and CEO of Hybrid Debt Fund and Integrity Capital, LLC. The company focuses on proactive commercial finance services for clients throughout the United States. Loan or equity parameters are 5 to 300 million, and they have funded over 2 billion to date. He's a husband of Jill, a father of 2 children, and a member and founder of H3Phoenix.com, founder CEO of Hybrid Debt Fund 1 LLC, partner in 𝐼𝐸 Park, ambassador for the Phoenix Rescue Mission, elder at Scottsdale Bible Church, and an advocate of the poor and disenfranchised. He won 4 out of 5 national championships for rugby and played in New Zealand and Australia. So David is an Eagle Scout, loves to hike, and is a huge fan of Chris Botti. So with that, I'd like to welcome to the show, David. Welcome.
Thank you so much for having me, George. It's a pleasure to be here.
All right. Well, it sure is a pleasure to have you because you do a couple of things that I find very fascinating. First of all, RV parks. I think that's brilliant asset class. A lot going on with that. And also, we're going to talk about your debt fund. I love private lending. I think it's one of the most interesting things out there to be able to lend and to have some collateral you can fall back on when things go wrong. Because I think, hey, anybody who's been in real estate the last couple of years, you've seen some things go wrong.
Just a bit.
I'll venture to guess that you have.
Yeah.
Don't have a crystal ball. But anyway, I'd like to start by getting to know you. So suppose you're at a cocktail party and somebody asks you, what do you do? How do you answer?
Well, I would say that we help individual investors get passive income through private credit and RV parks. So there's different channels and avenues that we offer for people just because of the distribution channel that we have. And so we try to provide very good returns with lower risks. So that's probably how I would answer that question.
Yeah, beautiful. Good stuff. Well, let's talk about RV parks. I mean, that's something that has really changed a lot since the coronavirus pandemic. We saw just huge interest in RV parks. So why don't you kind of take us through the last 5 years or so and tell us where do we go from here?
It's interesting because the first time that I looked into RV parks, one of my partners is very deep into it. I said, isn't that, kind of the rundown parks that people that are in their 60s and 70s do? And he said, you are so wrong. You have no idea. It's changed dramatically. And what he calls the digital nomad. So people that are in their 30s and their 40s, and they said, look, we want to be able to have the freedom to travel around the country and be able to plug in somewhere and have this beautiful experience and be there for a week, 5 days, and then we move on to the next. I remember even when I was trying to engage somebody to do some recruiting for us, and we were on the Zoom call, and I said, where are you? She said, oh, I'm in an RV park. I just travel around and I recruit people. And I thought, wow, this is real stuff. So that was my foray into it years ago, to get my head and hands around this whole thing of RV parks. And then the first thing that we did was to partner with a client of mine who had some land up in a little town called Black Canyon, where there's this really famous, what's called the Rock Springs Pie Shop. They actually ship about 180,000 pies out of there a year. And he asked us to come up and say, what would you do with this land? I've got 40 acres. And me and my partner walked up there and he said, I want to do storage. And my partner said, I don't think so. And he looked at it and said, that is an RV park, hands down. And that really became the foray for us to say, this is a huge industry. It's a massive industry of epic proportions, predominantly because of what I just explained, but also because the baby boomers that are transitioning money. And you're starting to see Starwood that's double downing in this space. It's really probably one of the last bastions of a roll up that we're seeing right now. So we just said that's the space that we want to dive into, and we have.
You say last bastions of a roll up, because I imagine this is still early days for these roll up. Actually, can you define that? I think a lot of people make some of these private equity terms.
Yeah, a lot of times what happens is you get into industries where it's fragmented. I mean, this happened to the self-storage industry, where it was just a lot of ma and pa industries and individuals that started a couple of self-storage facilities. And then what happened is the big boys in Wall Street looked at it and said, wow, there are great returns in the space. So let's go ahead and defrag and roll up these small operators into a large operation, and then we can eventually scale it and sell it. And so when you look, the same thing happened, by the way, in the car wash industry, where it
Oh,
just
yeah.
went through a life cycle. And now we're seeing this early days of the RV parks that,
Yeah,
again,
mattresses, death care. It's a story
100%.
I've seen again and again. Yeah, people are interested in
Yeah.
private equity. There's always an industry that's full of mom and pops, and right now it looks like that's the RV industry. So yeah, so it's still growing as I understand. It's not like the crazy days. I remember after the pandemic, you couldn't
Yeah.
rent an RV, couldn't
No.
buy one. Everything was on back order.
It was a question that we asked. We said, is this just a short-term trend? Kind of like when you would walk down to the scooter store during the pandemic and everybody bought every scooter. That person's revenue just shot through the roof and you knew that wasn't sustainable. There absolutely was that with RVs. What we have decided to focus on was two ends of the strand. So we said, we're just going to focus on luxury RV parks. Okay. So people that have a lot of disposable income and they want to have a great experience at great locations. And then we also want to focus on more of the affordable, where there is a need for affordable housing. So let's build parks where it can be a longer term stay. And so we think those two spectrums, we believe will be good long-term strategies right now. And plus our approach is we're not going to have high leverage on these as well.
Great. Yeah. So I'd love to hear how you drive value. So you're
Yeah.
doing luxury and some on the lower end. So
Hmm.
you obviously have at least two different strategies. So when you
Yeah.
acquire these parks, what condition are they generally in, and then what do you want to do to drive further revenue?
Yeah. The one we are involved in right now, 40 acres. And the first component of driving value is really making sure that it's the appropriate location. And what I mean by that, when you deal with an RV park, it's imperative that you have some things around you that are going to be a draw. So, for example, in this specific location, it's a famous location. You also have all of the desert scape, so people can go four-wheeling, and you can go down 10 minutes to go golf. You can go up to Flagstaff and Sedona. It's right slap dab in the middle of it. So proximity is huge. I mean, you have to make sure, because when someone's going to hop online and go, why do I want to go over to this location? You need to have a draw for 5 to 6 days. That's the first component that you have to make sure you do. The second one is to make sure it's not saturated. So we looked up at Zion's Park. I'm from Utah. I used to go to the Zions all the time. It is saturated. So we just said we're out. There's just too many parks there and too many coming online, which is not going to drive value. And then obviously the third one is just making sure that we are honed in on the end user to say, we have the internet that you need. Do we have a dog park? Do we have a clubhouse, pickleball courts that we're going to have in there? All the specific amenities that somebody wants to have that experience when they're there, so that there are plenty of things to do when they go there as well. And then in this specific park that we just launched, like I said, they're shipping 180,000 pies out of there. So the marketing is fantastic for us. So those are some of the ways that we really try to drive value and, quite frankly, basis. You know, our land is really cheap, and we have to make sure that we're in the right basis so that, we're not overspending.
Got it. I love it. So you're looking for maybe a good entry price. I get it, and then a
Yeah.
lot of amenities. So okay, David. So a lot of our investors here are interested in multifamily. They might be multifamily operators. So what are some of the things that they're going to want to look out for when they get into that first RV investment?
Yeah, it's a great question, George. And I would say a few things. One is you need to focus on the areas that are uncontrollables, meaning demographics and if there's actually a tsunami going on, right? So for us, we had spent a lot of time looking at the space to say, who's really in the space? Is there a trend? Is there a market for this that is sustainable? So I think the first thing for due diligence is to ask that question and really do the due diligence through the, KOA and some of these groups that put out large reports to show that there is this shift, there is this demographic for people that want to be in the RV space, especially with younger people. That's the first thing I would look at. The second one is to say, what are the risks? What are the major risks that you run into when you're at a park? Well, a couple of things. One is, again, like I mentioned before, is it in a location that people want to go to? And there's a reason why they want to get in their RV, which they probably spend $50,000 to $100,000 plus for, and drive across the country and go to this location, and for how long. So you need to ask that practical question when you're asking, why would somebody want to go here? Does it have visibility, and does it have water, and does it have a desert feature, and other factors? And then the other one is just the basic economics of it. Does this underwrite? What stabilization do you need to be at? Because you have to realize in an RV park, it's going to be seasonal. Some areas will be more seasonal than others will, depending upon the actual weather patterns. And so in Arizona, it gets a little hotter last time I checked and felt. And so you have to understand, what is that rolling occupancy going to be like? Do I agree with the assumptions? And making sure that you're talking to experts around testing those things. And the final one is just leverage. How much equity is in there? How much debt? I think we all know since 2022 that the high leverage stuff, it got hurt. It's just part of the element of basis. So I think those are the things to mainly focus in on when you're trying to do due diligence, and then making sure you have a team that knows how to execute and has a track record. So.
Yeah, beautiful stuff. What about the due diligence? I know one of the things that RV park operators really hate or actually here, I guess maybe I'm leaning a little bit on a related field here, but uh, actually here, China, can you just go back and just nix that? Never mind, off the track for a second. Yeah, so what are some things that you need to look for during your due diligence of an RV park?
Yeah, look, if it's an existing park, which we tend to do more ground up, but we are looking at a lot of existing RV parks. What are the trends historically? Can you get your hands on historical profit and loss information and really understand what are the trends? And comparing that to what you really believe that these things can operate at. That's part of the challenge when you get P&Ls, is to say, were the operators really operating that at too thin of a margin, or are they operating it at an institutional grade? So we try to look at those and make sure that the margins are appropriate. You really can operate at those. And then obviously the top line assumptions of, seasonal occupancy and trends year after year. Is it getting worse? Is it getting better? And what are the reasons why? That's the first thing in due diligence. You just need to see what has been going on historically. The second thing I think you have to look at, which is really important, is to say, why do I even want to be in this location, and can I turn it around? Some people have great ideas to go turn something around. They just don't have the ability to do it. So there has to be a tangible reason. For example, there was a place up in Gilbert, Arizona, where it just seemed like every single restaurant operator that went into this location up there just died. And so you just kept going, what's the next guy going to do that's going to be any different? And so I think
Right.
you have to ask, why is that really going to be different? And what are you bringing in that uniquely, tangibly different other than a great idea? And so I
Mhm.
think that's the second thing in due diligence. And then the final thing is to really ask yourself tough questions. Who's the competition around here? What's really going on in the area that's going to make this thing different? And quite frankly, are you going to get smashed down by somebody else that's going to come in down the street and open up a park, which, by the way, has happened a lot in the car wash space and the storage? And you'll see saturation. So I think you have to be willing to be critical and your own critic when you go through due diligence, to not be convinced. In fact, to give you an example, we went through our park and got almost all the way through Yavapai County to get approvals. And all of a sudden, our construction costs came in higher. And, I said to the team, I said, guys, one of the greatest sins is that you get so involved into a project and you spend, enough money that you feel emotionally invested to keep going forward. And I think you really have to be able to ask yourself the hard questions, even when you get down the road to say, should we really do this?
So
And
what did you do then? So construction comes in higher than expected.
yeah,
Did you abort? Did you pivot?
yeah.
What did you do?
Well, the first thing we did is we took a timeout. We stepped back, we rallied as a team, and we said, look, let's go back through all of our assumptions. Let's go back through our due diligence and let's ask ourselves the hard questions. Do we really feel like these assumptions are appropriate that we had, and retool those around with the management companies? The second thing that we needed to say was, are there areas that we can make adjustments in our budget that's not going to compromise what we're trying to do at a luxury park? Are there things that we can take out of there that is not going to have a major impact? For example, if we're laying down pads, we don't need to have extra gravel over here, or we don't need to have cement over here. It's not going to make that big of a difference. So really, re-engineering some things was the other thing. And then honestly, we spent time going back to all the appraisers that specialize in RV and say, look, do you believe that in this value, what we're doing, we can still create upside economic value for the going concern? And after doing all the due diligence, it took about 3 weeks, we were prepared to walk away. And that didn't feel good, but we all came to the conclusion with the information that it still makes sense to go forward. And so we did. But we were prepared to walk away because I do think that's part of disciplined investing. You have to be willing to just say, no, not going to do it.
Well, can you tell us what is one thing that most people in your industry believe that you think is not true?
Specifically in the RV space, or
Yeah,
just as a,
or
yeah.
private debt.
I would say for private debt specifically, that people think that all private credit falls into one category, and it's just not true. In fact, I'm doing a series on LinkedIn right now that I'm going through every single type of private credit to
Mhm.
walk people through the distinctions of all the different types that have very different risks, very different returns. And so I think I would say that's probably the number one thing that people just tend to, they go BlackRock, private credit, it all falls in one category. And that's not really accurate.
Love it. Very true. So what would you say is the biggest challenge? Let's do a little more on the RV parks
Yeah,
for a bit. Yeah,
sure.
what's the biggest challenge? So obviously things have changed. You saw that great big
Yeah,
run up. Now you're seeing, I think, more, as you mentioned, people looking for luxury, right? It's not what it used to be.
yeah.
So where are we now?
I'd say a few places. One is we have a group right now that we're in the middle of negotiations that is fairly significant, that's going to be doing some backing on us on the equity side. They've been mandated to go and deploy capital. Their specific strategy was, hey, we're going to go get parks that just limped along and they're in distress, and we're going to buy them. And that hasn't happened. So there was this thesis that took place that really isn't happening. I think predominantly because a lot of these park owners have a pretty low basis. And even though they might be mediocre at best in the way that they operate, at some point, you just have cash coming in, you go, it doesn't matter. I don't need to sell. And so that is one of those realities. And so new parks are the way we're going because it's going to be tougher to do that. That's the first thing. I think the second thing is cost of capital. People are still trying to figure out, how do we make these things pencil at these rates? So that's a challenge where we tend to take more of a, we got to be at a low basis, and we need to make sure that our construction costs are in line. And the other one is, quite frankly, construction costs still are not cheap. I mean, that tariff thing didn't really help trying to run up some of these things. So I think those are probably the big ones that are still looming around for people to go, what do we do with this?
Okay, interesting. So can you tell us what are some of the mistakes that you see investors making these days?
So the investors, what mistakes do they make? I would say it's really centered around probably two things. One is not asking maybe enough questions. And I think the other one is just not asking the right kinds of questions. So both of those could fall under the same category, meaning that one might just be out of ignorance. They just don't know. The other one might be just out of embarrassment, possibly, or hey, I don't want to push too much. So I think,
You're talking mainly about the passive investors here, not
yeah,
asking enough questions.
correct. Yeah. Yeah.
Okay.
I think that's what you were asking. But if you're asking about
Well,
what
yeah, it
do,
could be either way
yeah,
because, I think both sorts of investors are important to us. Of course, here's our podcast title, Passionate Living Through Passive Investing. I think a lot of people, the dream is to be that passive investor and just live life like the couple on the cover of my book. But the reality is that most of us, we're still out there grinding it out.
yes, very, very true. And it is one of those things that you need to be intentional about and obviously do homework about, and also to understand perhaps your craft. I was listening to a gentleman the other day, and he had had some advice saying, look, whatever your craft is that you understand, probably spend 80% of your time in there, and then, 15, 20% of the areas you might not know, just because you understand that space. So for me, when I invest, I understand real estate. I understand
Yep.
private credit. So yeah.
Yeah, love it. Well, I think I'd definitely like to spend some time talking about private credit. That's very broad field, as you mentioned.
Yeah.
It's really many, many asset classes under a single large overarching rubric. So tell us where you fit in that private credit
Yeah.
landscape.
Yeah. So we have a private credit commercial real estate fund. And for us, we specifically lend money, 5 to 15 million, to developers and investors that are in multifamily, they're in retail, they're industrial, and they're in storage. And they are in a position where they're saying, hey, I can go to my bank, I can go into a private group and get 65%. Where we're different is we'll go a little bit further on the stack. So we might go up to 80%, 85%, maybe higher, and we give them a fixed rate loan for 3 years, and then we take a participation on the upside with them as well. So that is what makes us unique, is that we have a private credit instrument that you get ongoing income, but then we also have the pop at the end where people can actually make that upside participation on that loan. And we usually take 30 to 35%. So investors in our fund, they make 5.5% current coupon. And then what ends up happening is they'll make somewhere in the ballpark of IRR of 11 to 13 between the economics that we have split. So that's where we fall into the space of private credit, commercial real estate in that world.
Yeah, beautiful. Very, very exciting. Actually, one thing I did want to touch on with the RV parks before we leave that is,
Yeah.
do you have any sort of property management horror stories that you can share with us?
Thankfully, no. But
Okay.
I know they're out there, and I'm sure that'll happen at some point. But thankfully, we have not yet. But I'm certain at some point that there's going to be. In fact, I do own apartments myself, and I can tell you some fascinating stories as well. Just probably more on the tenant side, that you just kind of shake your head and go, "Wow, that didn't see that one coming."
Yeah, so David, I think anybody who owns property has some pretty fun tenant stories,
Yeah.
or I like to call them tenant horror stories. Are there any that you'd be willing to share with us today?
Yeah, I would say we've had some fun ones where I remember, these are wisdom wounds, as I call them. You learn lessons early on that you sit back and go, not doing that next time. So we had not put a provision in our lease early on where there wasn't like a minimum amount that you had to fix it yourself. That's basically what it was. So we had this gal that was in one of our rental units that she would call us almost every day. Hey, the light bulb went out. I need you to come over and fix it. This went on and on. And then every single month, me and my wife would laugh because we knew what was going to come about 3 days before. We were going to get a call from her, and she was going to have some story of why she was going to be late. This guy died. And we just, all the way to the end, at least 2 years in, it was just this holy cannoli. And so, yeah, that was one of many stories that I remember our property manager said, I'm going to write a book on all the stories that I've done. I said, that would sell big time." So,
Yeah, I believe it. I've got a few stories of my own, but every time I interview particularly a property manager, they've always got some of the best stories
yeah,
I've literally ever heard, like
yeah,
unrepeatable stories.
yes,
That good. So, you know what? We've been talking about private debt a little bit, and you did talk about some different aspects of private debt. Did you want to go any deeper and tell us why you are sort of where you're at? So you go a little higher in the capital
yeah,
stack, you have some participation.
yeah,
So I think you're going into some places where the banks don't go. I think it's
yeah.
basically the bottom line.
Yeah, if you look at the landscape we're in, you have the first component of a frozen market. Back in 2022, when the interest rates went up, all of a sudden you had large institutional equity go off the sidelines. They just froze. They said, we're not going to invest. Well, when that happens, then it's a trickle effect. So you have large groups like life companies that start to slow down. You have all of a sudden, normal private groups that got really stung because they levered up too high. And so those properties went down in value and now they're stuck. And all of a sudden, those interest rates went up dramatically and their interest rates are burned off. So a lot of groups just froze and people were driving through fog. And so we looked at this as an awesome time because banks, same thing, they're in a deposit grab right now, trying to figure out how to get liquidity when they're not getting payoffs. So this is a tremendous opportunity where people need liquidity and they're not getting it. They're having a hard time raising equity. So we have a product called a hybrid debt loan that goes higher on the capital stack. What it's doing is it's solving for that developer's problem where they
Yeah.
need to get more equity. And it's also solving for their problem because whenever you're a developer, you're in this juxtaposition where you're going, I got to tie up the property, then I got to go get debt, then I've got to go raise money, and I have to do this all within this time frame. So it's very difficult and stressful, to say the least, to try to juggle that. And so ours solves for that specific problem of a one-stop shop, and we believe the economics are more favorable, and it also provides our investors a better return on their investment, while, by the way, minimizing their risk because we have a first deed of trust. We start off with a personal guarantee, a repayment guarantee. And so things don't work, we foreclose, right? So we
Yeah.
really believe in the instrument and private credit as a whole.
Yeah, I like it. And so you are doing a couple things there differently. Well, actually, not really. I mean, a lot of banks are going to require that personal guarantee, et cetera. So you're going
Sure.
higher in the capital stack. Have you been burned, or are those safeguards enough? Or maybe you're getting, the returns that it
Yeah.
evens out.
Thankfully, we haven't. That's not to say that there's not going to be some bumps down the road, but I would say we do very thorough underwriting. We need to make sure when we do a deal, there is a lot of margin for error. So our number one test is to say, I want to make sure there's 150 basis points to 200 basis points between what I call the yield on cost, which is the final future NOI divided by the cost, versus their cap rate exit. And if it's 150 to 200 basis points, it's a good starting place for us to know that we have some margin for error. And then obviously the same thing before, we're looking at the location, but the primary thing we look at is the sponsor. Do they know their craft? Have they gone full cycle enough times? Do they know their backyard? We really want to make sure somebody is very, very poignant on their craft. And that's what we look for because that operator is really going to make or break, with the exception of some tsunami, of a deal to happen or not. So there's a lot of due diligence that goes into it to make sure that even if we have to foreclose, George, that
Yeah.
we're okay owning that property.
Beautiful. Well, here, before we go into our wrap-up questions, I'd really like to ask you about your rugby experience.
Sure.
I've noticed in my life that it's really the most elite things that people do, like music or athletics, that often teach the deepest lessons. So, uh, through four rugby championships, what sort of lessons did that teach
Sure.
you that you can use in your business and life?
Well, I was fortunate to play on a team with a coach. His name is Larry Gelwix. And Larry coached for 35 years, and he only lost 10 times in 35 years. So he built a dynasty. And one of the things about Larry that I just I didn't understand it at the time, but I do now with a little more gray hair, is the power of building a really robust culture. And that's what he did really well. He cared about the boys, he poured into them, and he made it really clear that on the totem pole of life, he'd always say, look, your faith in your family's up here. And he says, rugby's way at the bottom, but he says, your character matters more than anything. And I mean, I could go on and on of the lines over and over that I heard for the time I played, but I would say just that the teamwork, the diligence, he worked us harder than anybody. And that's
Yeah.
why one of the reasons we won. And he just built a culture that it wasn't just a game. It was like, this is part of our life. And so I'm just super grateful for that. And I think it's spilled over in the way we try to do business as well.
Yeah, beautiful. Well, now, before we go into our final round, I'd love to do I call these the getting to know you questions.
Sure.
So I'd like to ask you, first thing that comes to your mind, beach or mountains?
I am a mountains guy for sure. 100%.
Okay, love it, love it. Okay, sweet or savory?
I am a sweet guy.
Okay, good. Last song listened to.
Oh gosh. I think it was Rest by Carrie Job, I think was what it was.
Okay, all right. All right, how about this? We'll just end with favorite holiday.
Oh, Christmas for sure.
All right.
Yeah.
All right, good. So with that, that was our whimsical round. So let's go into our more serious questions. I call this the seven. So if you could be known for only one thing, David, what would it be?
I'd say integrity. So yeah,
What is one mistake that taught you the most?
I would say be slower to hire when you make those decisions and be slower. And I'm not just talking about people that you hire physically, but people you work with.
Yeah, wow. Partners, huge. What personal characteristic has been most pivotal to your success?
I would say diligence and discipline.
All right, now here, we've got to have something whimsical in our seven. So I've got these random question cards. So just tell me when to stop cutting.
Stop.
All right, top card. What's your favorite song to play in the car?
Oh, for sure. I would say, Chris Botti, yeah, I love all of his songs. I mean, I've been to a couple of his concerts, and every time I'm there, I'm like, wow, blows my mind.
All right. What's one tip or trick that investors can implement in their business today?
I would say that they should be really good about building an infrastructure to identify and look at deals. I think that's the one thing I've seen is just being able to build infrastructure in place. So,
All right. Can you give us some book recommendations? So give us a book that's helped to
yeah,
forge you as a leader or
yeah,
entrepreneur.
I read a lot. And so I would tell you that there's two books that really struck me as a leader. One was Five Dysfunctions of a Team by Patrick Lencioni, which has a great model of how to operate really functional teams. And then another one that I really was instrumental was Who Not How by Dan Sullivan. Those are two books that are just fantastic.
Okay, can you send us out with a quote to help forge our listeners as leaders and entrepreneurs?
Yeah, I would say that leaders drive values, values drive behaviors, behaviors drive culture, and culture drives performance.
All right,
So,
beautiful. And just one last for you, email, website, carrier pigeon, smoke signals. What's the best way to reach David Kotter?
yeah, Dave.Kotter, and that's Kotter at hybriddebtfund.com or 602-367-8795.
Love it. Beautiful. Thank you so much for taking the time to share your knowledge and experience with our audience, David.
Thank you. It was a pleasure, George.